Hi, everyone. This is Rob Barnett from Bloomberg Intelligence, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. Just a quick introduction going around the room here. We've got Salih Yilmaz joining us from Dubai today. Thanks for calling in. I know you're a bit jet lagged. Here in London with myself, just over my shoulder here, we've got Hares and Patricio Alvarez. And in the New York City metro area, as usual, we've got Fernando Valle joining us. So we're quickly approaching the midpoint for the year, and I think it would be just helpful to do a quick check-in on commodities generally. So Brent oil, we're mid-70s, 75 and change today versus about $120 a barrel a year ago. Now, if you think that decline is bad, European coal has gone from $400 a ton down to just over 100 today. And I think we're all familiar with the European gas story, but TTF topped out at over 300 euros a megawatt hour. We're sub 33 euros a megawatt hour today. I still have to kind of think about the conversion into US dollars per MMBTU, but even at that big steep decline, the TTF gas price is about $10 per MMBTU versus 2 and change for the Henry Hub US price. So just quickly to mention two other commodities. If you're looking at the solar side of the business, Polysilicon, a key input for that industry, we're at about $18 per kilogram today versus about $38 a kilogram last August. So big declines there as well. European carbon allowance prices could be one of the only outliers we're seeing on the screen today. So it's roughly flat over the last 12 months. We did flirt with about 100 euros a ton, but today we're in the mid 80s. So quite a bit of change over the last 12 months in energy commodity land. And so I'd love to go around the room and sort of get some perspective on that. So Salih, we're going to come to you first. I know that prior to I think the Russia-Ukraine crisis, there was a sense that there was a tightness in supply-demand balanced, kind of being undersupplied for oil, and this idea that if Russian supplies came off the market, we'd exacerbate that. Yet at the same time, that really doesn't seem to have come to fruition yet. And so, what's your latest read on oil macro, and how does what we've seen with Russia-Ukraine play into it in your view?
Thanks, Rob. Yeah, I think you're right that the supply side of the equation here is a lot more interesting and perhaps not talked about as much, because I think even on these calls since the beginning of the year, we've very much been focused on the demand side. But when we look at supply, and most importantly, in the last 12 months, I think Russia, I think we all have overestimated how much disruption there would be given what's happened. And currently, I mean, Russia is producing and exporting at post-invasion high levels. So we haven't really lost all those barrels that pretty much everyone thought that that would tighten the market. So that's not happening. And again, of course, I mean, on the demand side, it's a little bit of a tale of two different regions. I mean, Asia, especially China, reopening, we thought that would bring a lot of new demand this year, and arguably perhaps China is not recovering, Chinese demand is not recovering as fast as many thought, but still Asia is recovering. I think a lot of the pressure, there's a lot more pressure on the US, Europe, with monetary tightening being a huge overhang on prices because it's bringing expectations of much lower demand in the rest of this year. So I think there is pressure from both supply and demand side, but I think the Russia story is the one that's been key and probably the biggest factor keeping oil prices in check, especially in the last few months.
I'm going to follow up just quickly. So we'll never have the counterfactual, but if Russia hadn't invaded Ukraine and we hadn't had sort of the concern about their ability to participate in the market, would we how do you think the world would have gone in that scenario?
I mean, arguably, we would have had even more demand from that region. And I think before the invasion, what we were talking about was how um, demand is expected to grow further, and we just weren't sure if most OPEC Plus members would actually be able to meet that extra demand. I think eventually we will get back there. I think eventually, as demand recovers, we will go back to talking about whether Nigeria can produce more, or if Angola can produce more, and how much spare capacity does the rest of the group have. But I think what this has done is, and in the beginning, I think we've seen Russian production fall a little bit before it started creeping back up again. So I think back then we were talking about still a tight market. We're talking about whether OPEC would have enough in spare capacity to fill that gap. I think we've just kind of taken a break from that, but I can see later this year or perhaps early next year us talking about pretty much the same thing again.
Okay, Will, I want to bring you into the conversation. What's your sense on the oil macro story, and how does Russia play into it? I know probably a year plus ago, a number of your oil majors that you cover were writing down assets in the region. Has any of that affected anything from a supply perspective?
Yeah, from the European energy major side, most of the budgeting and distribution policies have a floor of $60 or $65 a barrel. So from a strategy standpoint, things remain unaffected, and of course any upside is sort of all gravy for these distribution policies that we're seeing, and we saw that in 1Q as well, with maintenance of buyback programs from Shell and Total, and even an upgrade from Equinor. So despite a lower backdrop, these companies are still generating material free cash. Obviously, it's going to be significantly lower than last year, but I think it just goes to show that, given the balance sheet capacity that we're seeing, the gearing levels, the sort of maxed out distribution packages, that we are sort of approaching a likely an M&A window for these companies, either energy transition or traditional oil and gas. And I think that's shown by the recent report that Total Energies was poking around at a potential Neptune Energy acquisition, which is one of the largest privates in the UK North Sea.
Fernando, let's get your perspective on the broader oil market and read into some of the equity landscape over in the US. Do you agree with how Will and Salih are seeing it? Is that the same kind of narrative that's playing out over there?
Yeah, I think the other aspect is just demand and how the war itself has impacted demand, and governments printing more money at one point to counteract those issues and fund some of their efforts in building inventories, natural gas inventories, or building more energy transition, and now counteracting some of that inflation cost by raising rates. Ultimately, that's, I think, how the impact is most felt in the oil market. Also remind you that, on the US side, we released 220 million barrels from our strategic reserve to quell some of those prices. So if we not a long-term factor, but in the short term, certainly help quell some of the price upswings. As far as the equities, we are starting to hear more and more rumors about acquisitions, similar to what Will said. Even with lower oil prices, the companies are generating a lot of free cash flow. We saw in the first quarter, Exxon and Chevron meeting or exceeding their very large buyback plans and dividends, even with greater investments. And the rumors of Exxon and Pioneer, which have been around for, I don't know, 10 years at least, resurfaced as well. And it's starting to make sense because increasingly the Permian is becoming the land of very few. It used to be a very pulverized play, but then M&A, not just in the public equity, but also in private equity, has consolidated a lot of the holdings. And if you look by the end of the decade, over 40%, if not 50%, of the production from the play is going to come from the top 5 producers in the basin: Exxon, Chevron, Conoco, Pioneer, etc., and Occidental. So we could see more consolidation, and I think as opposed to Will's companies that have focused more on the energy transition, on the U.S. majors would probably look to extend their backlog in legacy oil and gas.
Is your sense that a lot of the U.S. M&A activity would be more traditional E&P focused? I'm reading between the lines and sort of hearing that, unlike Will kind of mentioned energy transition type M&A as well.
I believe so. I think there could be some deep water or LNG as well, but I think they will mostly play in the E&P space. And shale is one opportunity, but there are very few portfolios that are both attractive, that have a lot of running room, and the breadth that would be necessary to make a dent for an Exxon or a Chevron. You know, obviously Pioneer. You could say Endeavor, which is a privately owned company, would be some that would make sense. And then even among the smaller players, there could be more consolidation as they try to get the scale to be meaningful in a Permian Basin that's dominated by giants.
Okay, very interesting. Patricio, let's switch over to you, get a little bit of perspective on the gas side of the equation. As I mentioned at the start here, European gas prices have really taken it on the nose over the last 12 months. In many ways, that's good for consumers, probably helps governments as they're trying to manage inflation. And I know one of the ideas you and I had recently discussed is this idea that potentially we're facing a glut of LNG supply. So give us your read on the fundamentals on the gas side of the equation, and how likely are we to see prices kind of be at this more muted level that we're at today?
Sure. I think first let's address the supply idea. I think what we are talking about in Europe is a glut or an excess of regasification capacity being built in the continent. It doesn't mean that we think we're in a global LNG supply glut, but rather that perhaps Europe went too far in building too many regasification capacity, and that makes sense from a strategic standpoint. So it's not something. Let's say it's just to replace pipes. Basically, FSRUs, which are the floating regasification units, can come online much faster than traditional facilities, and they also elude all the risks associated with building new pipelines to interconnect between countries. Considering that the UK and Spain have most of the regasification capacity, the continent has just went out and built their own facilities in each country, such as Germany, the Netherlands, and Finland, which are seeing new regasification capacities come online over the next, this next 12 months, and have already come online during 2022. Now, in terms of the fundamentals for gas prices for the next 12 months or so, we have seen prices, as you said, come down, or that they're about 10 times lower than they were versus their September peak. And we do expect to see some continued weakness during the shoulder season. So shoulder season being spring and entering into the summer, or the second half of summer, when the reinjection season really kicks into gear. And we do expect prices to tick up during the reinjection season and into the heating season in October and November. We are less concerned of the upside risk for prices, just given that we're so far along into the year, and so far Asian demand for LNG has been sluggish. and most observers see demand staying flat, broadly flat in Asia, with China coming back by about 10%, but all that upside just being offset by lower demand in South Korea and Japan, which are deploying new technologies in power, mainly coal and nuclear. So I think we have seen a de-risking of the outlook. There is no more talks of a potential shortage, but we do flag that all these things are considering that that Russian gas flows continue flowing via Turkey and Ukraine as they are currently doing so. And even in that event, we would probably still be okay this heating season, but just kick the can to 2024. And then the other major risk is potential sanctioning of Russian LNG, because Europe continues to buy a significant portion of LNG from Russia, and we do see sort of a combinations of those two factors could bring us back into some significant price volatility over the coming months. But ceteris paribus, we're sort of looking past the worst now.
Okay, very interesting. Will, I want to come back around to you and build off the gas and LNG discussion that we're having here at the moment. About a year ago, you had a focus idea on Equinor. You pointed out early this idea that they could see a pretty big boost to their earnings and cash flow at the time they were the #2 gas supplier into Europe, now #1, I think. But when you look ahead, where do you think about the dynamic of gas in the equation? Is that an exciting piece of the story for any of the European oil majors right now, or are you looking at other components of their business at the moment that have a lot of excitement and opportunity?
Yeah, absolutely. Gas is forming an increasingly important part of these companies' portfolios, and I think that is not necessarily in response to Europe's energy crisis, or really at all. This has been ongoing, gradual pivot of the production mix for several years now, even going back maybe even a decade or more. This is obviously in part driven by the lower carbon intensity of gas, but we are also seeing the benefits accrue to the European majors, which have established very large trading desks for not just gas, but all of their commodity exposure. But in 1Q, we saw the strength of these trading units, and which we also saw last year as well. But massive outperformance in trading and optimization gains in gas, which was a boon to earnings for BP, Shell, and Total. And so yeah, gas is playing a very important role, and with more liquefaction facilities coming online in the coming years, it's going to continue to rise as a share of total production mix. Right now, for the group, it's around 50%. We think that'll hit probably 55 to 60% by the end of the decade, and more longer term, it's slightly more opaque, the forecast, but we have the long-term view from Eni's management has said that they intend on being an 80% gas-weighted company by 2050. So that shows you the direction of travel that these management teams see over the long term. But certainly having oil exposure or maximizing oil exposure in the short term, as Fernando's American companies have stressed, has been a much more favorable short term strategy in comparison to the Europeans, and I think that's reflected in this persistent and wide valuation discount that we see between Europe and their American counterparts.
Okay, that's a really interesting idea. I think there'll be a lot for the rest of the group to weigh in on that idea of Eni's vision of hitting 80% gas in the portfolio. Salih, let's come to you first. My gut tells me that the Middle Eastern producers are probably not thinking that ambitiously about where gas fits within their portfolio, but you tell us how do they think about, how does an Aramco and others like that think about gas right now?
Yeah, I mean, not as much. I mean, I don't think we would ever see Aramco's kind of share of gas in its total output being that high, because I mean, they produce a little bit of gas, mostly associated, but the majority of their business is still oil. But we know that they want to invest heavily in gas, start producing a lot more non-associated gas. And I think the primary reason for that is they want to actually start using a lot more natural gas domestically, which would allow them which would free up a lot more crude oil to be exported, which is a more lucrative business for them. But at the same time, I think they want to be a bigger player in this new hydrogen economy. And they were saying, I mean, they said perhaps more than LNG, they would actually look into the blue hydrogen market and use a lot of that new gas production in blue hydrogen. But what I read in the last week was that I think some of those discussions with perhaps the end customers are proving to be difficult. So I think investing in LNG infrastructure and actually becoming an LNG player is in the cards for them as well. So and similarly, I think ADNOC probably not the same type of scale, but we know that they want to invest more into gas. They want to invest more. They want to be producing a lot more natural gas, and we know they IPO'd in the last, I believe, a month ago or so, their gas unit separately on the UAE exchange. So it's not, I mean, compared to the European majors, they're not producing so much gas where it's such a big part of their output. But I think we will see these producers increase their gas production as well.
Okay, Fernando, let's come over to you. Where does gas fit into the equation? Are we going to get anywhere close to 80% for any of your companies? And I would also just note that in addition to the North American oil patch, you also cover Petrobras. So yeah, how does a company like that thinking about any of these kinds of questions?
Yeah, absolutely. I think probably not, although, you know, Exxon is already fairly gassy, closer to 45%. But they are skewing more oily than the others. I think ultimately, if you believe in gas, you believe in electrification, right? Gas is it's essentially a power fuel as opposed to oil being a transportation fuel. So you really have to believe in the shift to EV for it to make sense. Otherwise, it's just chemically and physically a lesser molecule. It's 2 carbon atoms versus 6 in crude. So there's less you can do with natural gas. Obviously harder to transport, harder to use than crude oil. So if you look just on the pure basics of it, producing oil is easier and more useful than natural gas. And you can say the carbon intensity is there, but you'd really have to believe in electrification of the fleet, both light fleet and heavy fleet, which especially on the heavy, we're not big believers, but even the light is challenged by the availability of minerals and the grid itself, the improvements needed for the grid. And then, you know, you take it further to a company like Petrobras or Ecopetrol or YPF, and they serve so many purposes within each of their countries. And each of these companies is following a very different path towards the transition. So Petrobras, as you mentioned, they just put in new management. There's a change in the Brazilian presidency, which then led to a change in Petrobras's management. And they are increasing their investments in refining and offshore wind, both of which have much lower returns, especially in a place where it's hard to build as Brazil is. I've said this before, but in the 2008 to 16 period, Petrobras is going to build 4 refineries and a petrochemical complex. They spent $60 billion and they wound up building half a refinery. So not the most economic, rewarding investments out there. And I dread to think that would be starting again. And offshore wind is very challenging. Building offshore in Brazil is difficult. The grid is poor. and it is very hydro intensive, so it's not really set up for the intermittency of offshore. So it's starting, but it will be very, very interesting to see how they'll invest. And because Petrobras is not just a huge contributor to the economy, they're also majority owned by the Brazilian government. They're a huge contributor to the fiscal balance. They really have to be very careful how they make that transition and that push. And the poster child of how not to do it, in my opinion, is Ecopetrol in Colombia, where the government essentially pushed them to buy a 51% stake in ISA, which is already a conglomerate itself. It's an electric utility, transmission, toll roads, cell phone towers. Of course, why not add oil and gas on top of that? And then that was the previous government. The new government is now stopping any new licensing for oil and gas in Colombia. And lo and behold, the decline rates in Colombia are massive. And the new CEO at Ecopetrol says they'll use enhanced oil recovery, which is impossible in Colombia just by the nature of the oil fields. They have huge water, they have rivers that run underneath them. So you can't really inject anything into the large ones anyway. You can't really inject anything underneath it to increase recovery. So essentially, they'll continue to decline. The only growth the company has seen is actually in the Permian, where they have a joint venture with Occidental. And their cash flow is already suffering because there's a mechanism to keep fuel prices stable in Colombia, which the Colombian government is supposed to pay Ecopetrol the difference, but they haven't in over 2 years. And instead, they just have Ecopetrol declare massive dividends, which then cancel out that debt, but they never get the cash flows to continue investments. So our view is they're doing the transition by killing the hen that lays the eggs before the other one is hatched.
Very interesting. A lot of really fascinating dynamics with a situation like that there in Latin America. Patricio, I want to shift gears. I mean, obviously, you look after more than just gas. You look after some of the utilities here, and some of them have the sort of big sets of infrastructure sitting under the same house. But I want to really get your sense of this gas narrative from you. Are utilities, as Fernando noted, if you're really going to see gas take off, there's a power story, there's an angle on EVs, all of this kind of thing. Is gas really going to be used in a big way in electric power generation over the coming few decades?
So I think a good way to approach that is perhaps not in Europe, perhaps outside of Europe. So a lot of the utilities we cover here do have international footprints, most of them leaning almost equally between Europe, the US, and Latin America. So the story pretty much in Europe, I think, is like Fernando said, is an electrification story. It's absolutely a push towards electrification combined with a rising share of renewables. That's sort of the strategic imperative for utilities within Europe, and all of the policy is there to sort of backstop these strategies. The Repower EU plan sets out a plan to cut EU gas demand by almost 30% by the end of the decade. And that's mainly by energy efficiency measures and an accelerated deployment of wind and solar mostly, and batteries. And also they've put in place provisions that make it a bit tougher, I'd say, to find the economics to invest in new gas-fired plants, given that these have to meet very strict emission emission thresholds, and they also have to be hydrogen ready. So there's not a huge group of operators that are willing to go into a business that does not, that's at least not yet, that does not give them a guaranteed return. So it's very well known what the return of a gas-fired plant could be. It's not very much known what a hydrogen-fired plant could return, because that it's very much in an early stage. So we still see investment in that part being a bit incipient, aside from a couple of independent power producers that still believe in having the flexibility of having coal and gas and renewables all together in their portfolios. But by and large, the big utilities such as Iberdrola, Enel, all the let's say the clean energy majors, as they were called before, are pretty much betting on building more renewables globally. And that has taken them very much towards the US, where the Inflation Reduction Act is being dubbed sort of like the policy milestone for the US to actually move the needle in terms of renewable investment, because it gives those direct tax incentives, and these companies are very much active in that space. A lot of the European utilities have a first mover advantage. They've already built supply chains and the scale and the know-how sort of to replicate the models that they successfully have deployed here in Europe and the US. So long story short, I think at least within the European utilities, gas does not have a huge role to play in power generation over the long run.
Okay, thank you, Patricio. I think we're going to give you the last word because we're at time. We'll have to pick up the debate with our next one of these. If you're not a regular, we hold these calls on the first and third Wednesday of every month. Next time, we've got our friend and colleague, Mike McGlone, based in Miami, who's going to join us. If you're unfamiliar with Mike's work, look him up on the terminal. He's been a sort of very outspoken voice on both the oil and gas market. And if you're unfamiliar, everything we've been talking about is available on BI Go. You can go read our outlooks on the commodities. So Salih, Will, Fernando work on our Brent and WTI primers. We've got commodity calculators where you can go and mess around with the supply-demand balance, get a sense of what you think the market looks like. Patricio does our European gas commodity primer, and I do our carbon commodity primer. So if you want to take a look at those, let us know how you think we're doing with our assessment of some of the fundamentals. We'd be curious to hear from you. And all of the companies we cover, if you type BICO when you have the ticker loaded, you can read our outlook for that company and all the stuff that we have to say about the fundamentals for them. So we very much welcome your feedback and encourage you to not only read our stuff, but reach out to any of us if you have any questions. We're available on the terminal over IB or email. Anyhow, have a great rest of your week, and I look forward to being in touch. Cheers.